In this week's update, why the short-term selling pressure? What action should traders take? And I'm going to have a look at the Bitcoin chart. My name is Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, let's just start with the normal market perspective. There are some reasons why we're likely to see, in fact, probably did see the start of, on Friday night, a pullback in the US markets and therefore probably the global markets. Couple of reasons. Many stocks had run too far too fast, and it was really interesting on Friday to look at the sector by sector movements in the States, and the stocks that had run the strongest over recent months were the ones that were sold off the hardest. The ones that have been the weakest did the best. And it's all related really to options expiry as well. So it was just an opportune time. The third Friday of every month is when options expire, and there is a very substantial financial incentive for market makers to do some manipulation. So it's important to have just a little bit of an understanding so that you don't overreact to short-term market movements that are often just an aberration and can be ignored because they'll correct themselves in a week or so. So I'm just going to take a minute just to explain that for those, whether you're interested in the options market or not, it doesn't matter because it does have an impact on stock pricing. So when markets are running strongly as we have, and a number of stocks are trading, have gone up so far that call options, there are a great many, call options that are what's called in the money. In other words, the price is well above where the call option was established, and therefore there's a great deal of embedded profit, if you like, in the call option. Now, the market makers gain in several ways. They gain by initially selling the premium. So if people are buying calls, then someone has to sell it to them, and that's the market makers. So the market makers sell calls to traders and they get paid a premium. So that's the first way that they make some money. The second way is that they then go and hedge their position by buying the stock, because otherwise they would just be exposed. And so they make a profit on the rising stock price. And then running into options expiry, they sell their long position, put the profit in the pocket, and then actually go short. And that drives the price down. So they make money on the way up, they make money on the way down, plus they pick up the premium as well. So they clean up all round. So there's a tremendous financial incentive for market makers to manipulate the market of stocks that have done really well. So if you see stocks that you're in that have had a very substantial short-term plunge, then don't overreact to it, I guess, is the important message. So in general, what should traders and investors do? Well, investors don't need to do anything. This will all be blown over in a week or 10 days, and maybe not even that long. So investors only really need to take any action if they just dislike short-term gyrations in the market, because that's what we're going to see in the next week or so. We've just completed the seasonally strongest 2 to 3 months of the year, and we're now entering from the third week of January, just for a couple of weeks, one of the weakest periods of the year. So traders could consider cashing up to a degree and just set for the next phase. Take some profit off the table, raise some cash, and be ready to pick up on some of these stocks that are being sold down because of this short-term market manipulation. So, American stocks, the S&P fell 1.5% across the week. Most of it occurred on Friday. Prior to that, it was the market was pretty flat. And as I said, it's just completed the strongest period of the year from November, December, and January on a normal seasonal basis. But we have got, and this is quite encouraging, we have got the Russell 2000 at new highs. We've also got the Dow Transports at new highs as well. So, they're good solid indicators of a good, strong, broad market. Now on Thursday night, Friday morning, the new US administration announced an incredible stimulus package, $1.9 trillion. It's got to get approved yet, and the Republicans may not support it, but the market always loves stimulus more than anything else, and that is certainly putting a significant floor under the market. Now the US dollar got down to support, and right on cue it bounced up to 90.78. That of course put downward pressure on other currencies, and of course downward pressure on commodities, including gold. It looks very technical. We were down to an absolutely major support level, and we got a bounce. In fact, it would be unusual not to have got a bounce. And also the 10-year yield had got up to about 1.18%. So the trend is up, but it did back off in the last couple of days, back down to 1.09. So let's take a look at some charts. And we'll start with the Bitcoin chart first of all. Now, let me declare my position. I have never owned Bitcoin. I'm not particularly enamored with Bitcoin. To me, it's all a bit too risky in terms of who might actually hold the funds or where the funds might go. Now, this is probably coming as a misunderstanding on my part, and I'll freely acknowledge that. However, I have had a number of requests to include the Bitcoin chart in these weekly videos. So what I can comment on, that I think I'm qualified to comment on, is the technical chart, because that's what I spend my life doing. So I'll make no comment about the fundamentals of Bitcoin and the safety of Bitcoin and where it's going, but I will comment on the chart. So we've had an absolute exponential rise that got up to nearly $42,000, and it had gone from, we got a consolidation here around $20,000 at the early part of December. So in 6 weeks we've more than doubled from just under 20,000 to more than 40,000. One would think that that's not a sustainable trend, and that it has to resolve itself with some period of consolidation. Now, what I look for in any period of consolidation, whether it's Bitcoin or whether it's stocks, is we look for the initial point of support, and I do a lot of this in Portfolio Analyst. We identify the initial point of resistance on the bounce, and most of the time that forms a lower high. And we then go into a period of consolidation. Now, you can see we've had enormous volumes of late, and not only have we got enormous volumes compared to back here, they're 4, 5, 6 times the volume, but it's also on a much bigger dollar value. Back here, Bitcoin was trading around 10 or 11,000. Now it's trading at nearly 40,000, and yet we've got 6 times as much volume. So clearly there is a lot more money flowing into the Bitcoin market. There's no question about that. Whether that's right or wrong is for others to decide. But from a technical point of view, I would be expecting that we'll go into some sort of decent consolidation. And the things that I look for whenever you get a sell-off from an exponential move like this is you want to look at the nature of the candles and the volume off the peak. Now, this first day down here, which was the 10th of January, it was a big range day, but it did close well off its lows. And you'll notice that the volume was also up. So when you get very high volumes off the peak, it tends to indicate that you will get a deeper, longer consolidation because there is more selling to be taken care of. But what was encouraging is the fact that it closed well off the lows. Now, the same thing happened the next day on January 11. And again, volumes extremely elevated. So it sort of makes for a bit of a muddy picture. Had these candles closed right on their lows, then that would be extremely bearish in the short term. But they didn't. So it's really hard to know how this is going to play out, other than I would expect a period of weeks or perhaps even months of consolidation. And it's really how quickly this volume settles down. It's whether we form higher highs or higher lows. It's whether we break this support. It's where the volume is on the up and where the volume is on the down. So I'll include this Bitcoin chart on a week-by-week basis to try and step you through how this is unfolding. But at this point in time, anyone that tries to tell you they know where the Bitcoin price is going in the next 1 to 2 months is absolutely kidding themselves, because there is no way of knowing how this will play out in the next few months. But it certainly is fascinating to watch. Won't get any of my money, but it is fascinating to watch. I guess what we desperately need, and we don't have it yet, is an ETF that tracks Bitcoin, because that would provide a level of safety that would entice me into the market, because I understand ETFs and I understand how they work. So hopefully sometime soon we will get some ETFs that will allow us to track Bitcoin. All right, let's look at the S&P. So we're still tracking above the 20-day moving average. So this is a trend of considerable strength. Now, what it does in the short term, with the market having been so overbought and options expiry and all the rest of it, could we pull back to the 50-day? I would think that's quite possible, and that's down around 3660, which is a bit more than 100 points below where we are now. That's not a prediction, that's just an observation of what might be possible. And we've seen in the past there was a sharp sell-off in September for a short period, another sharp sell-off in October, and they went just below the 50 days. So it's possible that something like 3600 could be in play, and that would also line up with the peak that we got in September. So I think somewhere between 3600 and 3660 is a probable area if this develops. But look, there is so much stimulus in the system that I wouldn't be at all surprised just to see the market continue on up from here, and just keep going and going. There's just incredible stimulus sloshing around the system. Now, if we look at the Russell 2000, this is IWM, you can see it's still tracking very, very strongly, and that's a very positive sign. All right, turning now to the US dollar. So we descended down to a very, very key major support down here around 89.5, and as you can see, we've bounced off it quite nicely, and it would have been quite surprising for that not to happen. There's really no reason to expect a change of trend, so I think we'll get a bounce. This is probably a bounce like we saw here, and over here. I don't think it'll develop into anything much more than that. And if we look at the Australian dollar, that's obviously been tracking upwards very strongly, heading towards 80, but we did close down on Friday under the influence of that bouncing US dollar. All right, turning to the Australian market, 76.7 was where we finished, and our index was lower by 0.6%. Now, as I've been saying, my focus over the last 3 years has almost been exclusively on stocks that are leading on the technology side, that are part of mega trends that I assess are absolutely unstoppable, irrespective of central bank policy, government policy, trade wars, geopolitical conflicts, whatever. There are sections of the market out there that are just going to continue to roar ahead regardless. So focus on the disruptors is my view, and ignore the rest. There is a lot of danger in chasing stocks that are paying a high dividend. Most of them, not all of them, but most of them are paying a high dividend for a very good reason, and that is that the business is in trouble, and a low share price is reflecting that. So if you're into traditional investments and chasing dividends, I would give some serious thought to your strategy, because I think it's going to be on the worst end of proceedings going forward. All right, let's just look at the Australian dollar. The Australian index. So the ASX 200. So we've broken out of this long consolidation that we saw from the middle of the year through to November. We've broken up a level, and now we're just going sideways again. Looking at gold, we'll look at the daily first of all. So a couple of sharp falls, and I'll explain that in a minute. It's largely around the positioning in the futures market, as it normally is when you get sharp moves. And so we're back now down just below the 200-day moving average. Silver is performing better. It's holding well above the 200-day. And there's gold on a weekly, and you can see that we got a breakout out of the channel. So we'd had a very well established channel since 2018. We got a breakout in July of last year, and the gold price surged through to the end of July, and then it's come back, and we've come all the way back down to the bottom of the trend channel. Haven't broken it yet. So that's how gold is looking. Now, if we look at GDX, we've certainly seen a bit of selling in the last few days. It was a bit nasty on Friday night, but as I'll show you when we get into the slide here, so gold was down $22 down to $18.28, and what would appear to have been the driver here is that there was a very unstably long positioning in the futures market. There was 412,000 contracts to the long side, which is right up there. It's not historical highs, but it's in anything above 350, 400,000 contracts to the long side is an excessive level of positioning, and is just begging for a catalyst to start a bit of a slide in the gold price. And that catalyst would appear to be the rising bond yields. So bonds have been sold. That's pushed the US 10-year bond yield up from around about 0.8 up to 1.1. That was enough to trigger a bit of selling in gold, and then of course that causes the speculators in the futures market to have to liquidate because they're using such high levels of leverage. So that's what triggers it. It doesn't change the long term, it's just impacting the short term, and so we just need that futures positioning to be washed out. Now, if we look at precious metals, I think the long term is still quite bullish, but as I said last week, and I think the week before, the precious metal stocks are far from a no-brainer. Yes, we'd gone down to the 200-day moving average, and yes, it looked like we'd done enough work to clear the decks for the next rebound. But I did say on several occasions that there was still some risk from the futures positioning, and that this was far from a no-brainer trade, and it still remains that way. So for me, gold stocks are interesting. They're worth having. They're a minor part of my portfolio. The vast majority of my portfolio is involved in high-quality stocks, involved in 5G, artificial intelligence, all manner of payment technologies and digital finance. It's precision medicine, it's biotechnology, it's renewable energy. All these areas are a part of mega trends that I believe are just pretty much unstoppable. Just turning to other commodities, copper. Copper didn't rise. In fact, copper eased back a little bit from 367 back to 360. The long-term story for copper just remains highly positive if you're looking out over the next 2 to 5 years. We've got a world that's being stimulated beyond belief, and we are going to see some reflation. There's a massive amount of infrastructure building that has to happen in several countries around the world, not the least being America, with such aging infrastructure. So the long term for copper does look very positive. West Texas Intermediate crude continues to track higher, 52.83, and this is largely around what Saudi is doing with production rates. So for me, crude oil is just an area that just doesn't interest me anymore, and oil stocks, it's anything but a mega trend. The headwinds, the social attitude towards oil and coal is really quite negative. So this is anything but a mega trend. And it's made up more unpredictable because there's geopolitical risks in in crude oil pricing as well. So it's just an area that I know some people continue to be involved in it and think it's part of a balanced portfolio. I have anything but a balanced portfolio. It's heavily weighted to the high growth stocks that have got very high probability of succeeding. All right, there's the spot copper chart. So we've just sort of leveled off a bit in the last couple of weeks, and there's the nickel chart, still continuing to edge higher, and we're up above $8 a pound. So to wrap things up, if you only trade in the mega trends, then you've really got little to worry about in terms of absolute risk. In other words, losing your money permanently or for a period of time that's unacceptable, like a year or 2 years or 3 years. I just don't think you've got too much to worry about it. If you chase prices, then you might be underwater for some time. But if you buy, you're clear about what you want to buy, you buy the dips, hopefully buy some significant dips in a little period like we might be just entering now, then I think you've got little to worry about in absolute risk terms. It's really just about timing and managing your psychology, managing the fluctuations. And that's really just being clear about what you're doing. So to me, the mega trends are where the safety is. The safety is not in a stock paying a high dividend, that's for sure. Keep tucking the partial profits away. I think where it sits at the moment with options expiry, and the week after options expiry is often quite volatile. I think this is a very good time to be tucking some partial profits away. The US market will be closed for trading on Monday night, but obviously reopens on Tuesday. So that's it for this week. Portfolio analysts this week, there'll be a 1 week pause in the normal video schedule. But anyone that has not gone and had a look at portfolio analysts, there are still the portfolios, and there are a number of portfolios now in both Australia and America covering large caps and small cap growth stocks. And also there's just such an incredible amount of learning in the archive, learning about fundamental analysis, about technical analysis, about strategy, about taking profit. So even though there isn't an actual edition this week, there's still an enormous amount of value in that archive. So that's it for this week. There's my website details and email address, and there'll be no video next Sunday. I'll be away, so there'll be a 2 week break until the next video. So that's it for this week. Cheers.